There's a shift coming on the 1st of December that everyone in the macro and crypto space is talking about. But depending on who you listen to, the explanations are completely different. Some people are calling it QE, others say it's meaningless, and a lot of the commentary misses the actual mechanics behind it. So in this video, I want to walk you through the real version, what's actually going to change on December the 1st, what it means for liquidity, and why the charts have been behaving the way they have over the last couple of weeks. No hype, no panic, just a clear, grounded breakdown that helps you understand the bigger picture. If you're new here, I'm Paula. I talk about crypto, macro, and the realities of trading without the nonsense. And if you want to join hundreds of normal people who read charts together, learn macro, and stop trading alone, our Crypto Wolfpack community is linked below. And remember, if you want to know the exact strategies we use to make money in both the bull market and the bear market, we've put together a completely free course for you, along with the link to the Crypto Wolfpack. The link is in the description. Right, let's get into this properly. The headline floating around is QE starts on December the 1st, but that's not accurate. The Fed is not starting QE, or quantitative easing, it's ending QT, quantitative tightening. Over the last few years, the Federal Reserve has been shrinking its balance sheet by letting billions of dollars of treasuries and mortgage-backed securities roll off every month, slowly draining liquidity out of the system, not all at once, but drip by drip, tightening conditions. On the 1st of December, that stops. The Fed will reinvest every maturing asset back into short-term treasury bills. That means the balance sheet flattens and liquidity stops deteriorating. If QT was the Fed draining the swimming pool, December the 1st is the moment they put the plug back in. They're not filling it yet, they're just stopping the leak. Now this is where the confusion comes in. Technically, this is not QE. There's no new money being created. There's no fresh bond buying program. But markets don't react to technical definitions, they react to liquidity conditions. If liquidity stops falling, if funding gets easier, if the central bank steps away from tightening, markets behave as if easing is coming. This is why people call it QE light. It's not money printing, but compared to the environment we've been in, it absolutely feels like easing. And historically, markets often turn long before full QE arrives. Just look at 2019, early 2013, the 2023 banking wobble. The moment QT pauses, the market tone shifts. So what's the short-term impact on the markets? The first few weeks won't be smooth. Whenever liquidity transitions, volatility picks up. You've got fast wicks, sudden squeezes, unexpected reversals, chop around key levels. Funds reposition based on the new environment. Bond traders adjust to changing expectations. Crypto reacts immediately because it's the most liquidity sensitive asset on the planet. Underneath the short-term noise, the big story is liquidity stops tightening. One of the biggest invisible headwinds disappears. What about medium-term market impact? This is the part a lot of people overlook. Some of the biggest markets didn't start during QE, they started when QT ended. 2019 is the perfect example. Liquidity stopped falling, markets took off, and QE followed later. The pattern is usually QT ends, market stabilises, risk builds, trend forms. QE accelerates the move if needed. Crypto especially responds quickly to this environment. Bitcoin usually leads in stability and direction. Then liquidity flows into larger alts. Then the risk curve rotates into mid-caps and smaller caps. We are entering the beginning of that potential window. So long term, if we zoom out further here, the Fed is ending QT. They've already started cutting rates. Fiscal spending in the US is huge. Government deficits are massive. Bond issuance is record high. This combination usually leads to one of two paths. Number one, a soft pivot. QT ends, rates fall gradually, markets recover slowly, and the economy stabilises. Number two, a hard pivot. Something breaks, liquidity injections restart aggressively, and QE arrives quickly. We don't know which outcome we'll get yet, but December the 1st is the first sign that tightening has reached its limit. Now this is where it gets interesting because the US doesn't operate alone. In the UK, we've got the Bank of England. The UK is already cutting, inflation is easing, and the economy is slowing. This leans clearly towards easing. Then you've got Europe and the European Central Bank. Europe is paused and leaning dovish. They're not tightening, they're waiting for inflation to settle. The next big move is likely a cut. And then you've got China. China is stimulating heavily. Fiscal, monetary, credit, all easing. They're pushing hard for growth. And then you've got Japan, the wild card. Here's where things get confusing if you don't understand global liquidity. Japan is tightening. The Bank of Japan recently raised its base rate to 0.5%, and they've signalled they may push it to 0.75% soon. They're doing this because the yen has been extremely weak, pushing up import costs and keeping inflation above target. So yes, Japan is the only major central bank tightening right now, but that doesn't cancel the global liquidity story, it just adds friction. Japan tightening mainly affects the yen carry trade, where investors borrow cheap yen, convert it to dollars, and invest in higher yielding assets, including crypto. As Japanese rates rise, that trade becomes less attractive. Some positions unwind, money shifts around, risk assets can feel short-term pressure. But the big picture? The US is ending QT, the UK is cutting, the European Central Bank is paused, China is easing, Japan tightening slightly. 4 easing forces versus 1 tightening force. Net global liquidity is still shifting towards loosening. Japan just slows it down, it doesn't reverse it. The cleanest way to put it is, Japan doesn't block the liquidity turn. It just adds a bit of resistance to the risk on side of the market. So really, what could go wrong? Liquidity pivots usually happen because something underneath the surface is under strain. QT ends when reserves get too low, lending tightens, credit markets wobble, the economy slows, recession risk rises. So whilst markets might turn bullish, it doesn't mean everything is fixed. It means the pressure has become too much to keep tightening. It's a shift, not a cure. And what does this mean for you as a trader? We're moving into a regime of change. You'll start noticing dips get bought, breakouts hold longer, volatility compresses into trends, liquidity appears at key levels, not all at once, not in a straight line, but gradually. These transitions are always clearer in hindsight. Understanding it now gives you an advantage, especially in crypto. If you want help understanding all of this stuff in real time, not days later, this is exactly what we break down inside the Crypto Wolfpack every day. We read charts together, follow macro shifts, help traders improve their discipline, and most importantly, nobody trades alone. The link is in the description. And if you found this video helpful, hit like, drop me a comment, and I'll see you in the next one.